Hello students, today we will be starting a new chapter under financial management subject, that is capital structure. As you have been discussing in our earlier chapter, that is cost of capital, this term you might have learned that what is capital structure. Then once again we can recapitulate it under this capital structure, because there are so many things will come apart from cost of capital under this thing. So what is capital structure and what are the compositions of capital structure? If you see that capital structure, main part will be equity shareholders fund, then preference share capital, long term external debts, outside debts, long terms. Then we will be explaining that what is the meaning of capital structure. You see that capital structure is the combination of capital from different source of finance. As you have been telling, no, capital have different source: the equity shareholders, preference share capital, and long term external debts. So this is the different source of capital. Now you have to see that what way or what are the basis in which we can select an ideal capital structure so that there will not be any problem in future. You see, the source and quantum capital is decided keeping in mind with the following factors. Which are those factors we have to keep in mind so that this problem will not be there? First of all, control. See, controlling is very vital part in any organizations, any stage purposes. You see that three different source of capital is there. Now in between them there will be an internal this way, that under whose hands that major power will be there. You see that control. Capital structure should design in such a manner that existing shareholder continue to hold majority stakes. Definitely. You see, in any limited company, major source of fund is your share capital fund. So in such situations, they should continue to majority stake. Definitely they will have to keep that way. Second options, that is their risk. You see, business, every point there is risk. So what they are telling here, capital structure should be designed in such a manner that financial risk of the company does not increase beyond the tolerable limit. So tolerable limits matlab is that risk could be there, but your composition in such a way the financial risk of the company should not go beyond the controllable limit. See, everything has some limit for controlling of the same. If you do not control the same, so nothing will happen. So that's why risk factor also you have to take into consideration. Last but not least, very important factor, that is cost. Overall cost of capital remains minimum. See, ultimately if your cost of capital is not at the minimum level, then your profit margin will not be there. So ultimately this shareholders' interest is there, the value of shares increase, their return they should get more. So that's why this cost of capital also important. That means number one is your control, in whose hands your exclusive majority hold stake would be there. Second one is the risk. Risk should be not beyond the control limit. This is the cost overall cost of capital should be minimum. You see that there should not be any ideal situation where all the three conditions should fulfill. So that's why you have to, what you have to do, it is very difficult to achieve the three goals. You cannot simultaneous all the three. So that means you have to keep in mind your organization's objective, some compromise you have to do. That's why they are telling that financial manager has to balance among these three objectives. They will have to balance, adjust. That is the thing. So keeping organization's interest in mind, they will have to make a balance. So then in sum up, what we can tell, capital structure is relevant in maximizing value of the firm. So that is a very vital. Value of the firms, your capital structure should be in such a way, your value of the firm should be maximum. Second option, minimizing overall cost of capital. So this is the two things. Your value of the firm should increase. Value of the firms, how it will be determined? Your share value will be increased, and minimizing overall cost of capital. So cost of capital should be minimum so that your profit margin will be there. Your fund cost, if it is a very vital factor for your corporations or organizations margin factor. So that's why this is, you have to think over this way. Now next point we will be discussing that how we will be designing as a capital structure decisions. Capital structure decisions, what way we will be going for that. See, this capital structure decision part, what we have to see here, it refers to deciding the forms of financing, the actual requirements and their relative proportion mix in total capitalizations. Again, we are repeating, it refers to deciding the forms of financing. That means which source to be tapped. That is either equity share or preference shares or long-term capital. Okay, which source to be tapped. The actual requirements, organizations fund, how much it is required, and their relative proportions mix in total capitalization. That means three things you have to keep it in mind. Which source you have to select, how much amount to select, and what is their relative source, that is what proportion. If it is 100%, whether equity shares will be 60%, preference share will be 30%, whether 10%. You might be remembering that in our earlier discussions, when we have weighted average cost of capital we have discussed, there you have seen that the individual source of finance wise your cost of capital might be more or less at par, but when you are taking into consideration the weighted average cost of capital, there it differs a lot. It differs a lot means weight is very important. That means the proportion. So proportion is the total funding expenditure depends. So that is also important. That's why they are telling that relative proportions capital mix, that is ratio equity share is to preference share is to long term debt. So that was the thing they are telling. Now we have been discussing here, no, maximizing the value of the firm. So what does that value of the firms means? Value of the firm formula is that EBIT by overall cost of capital, weighted average cost of capital. You see that this is a ratio between EBIT, earning before interest and tax, your earnings before charging interest and tax, how much your earnings will be there, and that should be divided by overall cost of capital or weighted average cost of capital, whatever the case may be. That will be the value of the firm. So here overall cost of capital KO equal to cost of debt into weight of debt. See, always you have to take the weight, otherwise your total cost factors will not come. To take an example, if your equity shareholders are 60% and your term loan and external debt 10%, so if you do not give the weight, what will happen? Here 6%, here 6%. So total your real picture will not come unless and until you take into consideration the weight of the same. So what percentage? 61%, 20%. So 60% into 8%, what does it matter? And 20% into 10%, same thing will not come. So that's why overall cost of capital KO, cost of debt into weight of debt, plus cost of equity into weight of equity. So both basic cost multiplied by that respective weight of debt, weight of capital. Now overall cost by formula wise you can give that KD equal to cost of debt into D by D plus S. Similarly, plus cost of equity equal to S by D plus S, where the formula KO is the weighted average cost of capital, KD is the cost of debt, D is the market value of debt. Here D is the market value of debt, S is the market value of equity. You see that what proportion total capital structure D plus S, out of the D how much? This is the cost of debt multiplied by the proportion. What we are talking about, no, that is the weight. D by D plus S plus K, cost of equity, into S, market price of equity shares, divided by D plus S. So your D plus S would become same, but proportion you are taking, when you are taking into consideration cost of debt, your D should be cost of debt you have to take into consideration. Here cost of equity shares also, market value of debt you have to take, and market value of equity you have to take, and cost K is the cost of equity. So this is the basic formula of your total cost of capital, organization's total capital you have understood. So now we will be going for another very important part that we have to take into discussion part way. See, what is the meaning of your capital structure this way? That is the basic things that you have to decisioning factor. So how you can take the decision, that is very important point to note. You see that financing decision process. Financing decision process. See how the financing decision process, it starts from your capital budgeting decisions. Capital budgeting decision. So capital budgeting decisions, what for you are doing capital budgeting decision? Number one, your replacement. Number two, your modernization. Number three, your expansion. Number four, your diversification. See, we have been discussing, no, that jo financing capital structure, why this finance is required? Finance is required, basically these are all long-term debts maximum. So that basically your capital budgeting decision purpose. You know that basic financial discipline is that your current assets should be financed from current liabilities, and fixed assets will be financed by medium and long term your source of capital. So that will be your financing decision discipline purpose. You cannot do this way or that way. So here, why these capital budgeting decisions, what purpose it is required? One is your replacement. Suppose your machines has been become very old, you have to replace the same and purchase a new one. That means when you are replacing your old value more or less zero. Then modernization. Suppose if you are to modernize in a factory, old model of machinery is not now relevant. What are the products you are going to produce? So in such situation, you have to modernize, and new machinery you have to bring it. Then expansion. Suppose your product range, your say 80% capacity you have been doing, you are getting some more orders, more area of business you want to capture it. So in such situations, you have to expansion project will be needed. Same product. Diversification is also one thing very important. Why this diversification needed? You see that you have been doing a product for a long period. That product for a long period would not stand unless and until you say, suppose you are producing for this pen one time. So lifelong you can prepare this pen. Sometimes you may prepare for these dusters also. Sometimes you may produce this books, papers also. So many diversifications you have to change it. So once your diversifications you are making, your this line of fixed capital expenditure should not be there. You have to establish a new line of machines, new line of setup. So every situation, so either it is a replacement, modernization, expansion, diversion, whatever the case may be, you need the fund. So fund you have to arrange for that, and that capital budgeting. So this capital budgeting decision is very vital part. We will be discussing with example and problem in my subsequent video lecture. Next point is your capital budgeting decision. need to raise fund. Why will be raising the fund? Why you have to take the fund from the market? That is there. You see that you do have internal fund, debt fund, number 3 external equity. You see, internal fund is nothing but your reserves, what have been accumulated funds over a period of time. Debt is your debt capital, and external debt is nothing but your equity shares. Market say you are taking the capital from these things, external equity. Next is your capital structure decision. You see, capital structure decision, financing process, third step will be your capital structure decision. See how this capital structure decisions, whatever the forms will be there. You see that number 1, your that existing capital structure. See, existing capital structure means at present what level is there, what may be your equity share capital, what may be your loan fund, what is your return earnings. So that is your existing capital structure. Number 2, desired capital structure. See, as you have been discussed earlier stages, that is why your funds is required, either expansion, modernization, diversification, all these things. So that time your existing capital structure may not be sufficient. In such situations, you have to new model of capital structure you require, that is your desired capital structure. Then number 3 part is your payout priority. See, payout priority is also very capital structure decision part. You see that those who are your term lending, you are taking borrowed fund for that, you have to interest, you have to pay timely. You see that, and after that your dividend decisions is your own your share capital. Dividend decisions is your, you see. So first priority after giving that interest, that is fixed portions, that is your dividend decision. See, here one point is there, payout priority is very vital for your cases, because you should have sufficient cash flows according to your priority part. Whether you see interest, that is the percentage, bank rate, everything you have to pay timely. So that's why you have to capital structure decisions, you have to which to be given priority, whether your organization, these financial sources or financial functionings are sufficient enough to make a balance between the two. That also you have to take into consideration. Now you see that we are to this desired capital structure, out of that 2 part will be there, your effect of return, effect of return, effect of risk. See, risk and return balance is there. So effect of return, you see, what is your profit will be there, your desired capital structure, that part will be one portions will be there, and effect of risk is there. As you have been telling you, your risk factor also should not go beyond the controllable limit. At the same time, this desired capital structure when you are making, what is the effect on your return? You see, once you are increasing your capital structure, definitely there will be burden in the form of dividend, in the form of interest. So that also you have to take into consideration, and risk factor also you have to take into consideration. Now, sum total of both these factors, effect of return and effect of risk. So ultimately it will come your effect on cost of capital, effect on cost of capital, optimum capital structure, and value of the firm. You see, value of the firm. See, ultimately, whatever you do that, you see that effect on cost of capital. So definitely your desired capital structure, your cost of capital part will be, your impact will be there. For that basis, you have to make an optimum capital structure. That is also very difficult. You cannot make an optimum at a goal taking into consideration your all these three things keeping in mind, and ultimately you are to reach to the value of the firm. So value of the firms depends upon your share value. So that value of the firm is very vital to take care, as you have explained, that EBIT by value of cost of capital. So this is the value of the firm is nothing but your earning between, this is a ratio between earning before interest tax and overall cost of capital. So this is your important financing decision part that is we have discussed here. So ultimately you have to make a good value of the firms to take into consideration. So next part, today we will be completing all these theoretical parts. Next, our another lecture, one or two more lectures, will be giving different theories of capital structure. You see that capital structure theories. See, capital structure theories means every decision's part, some base conceptual things will be there. Here, capital structure theories. See, here two branch it will be there. Capital structure relevance theory. Capital structure relevance theory. See, here again this part, it will go into three different form way. That is, number one, your net income approach, NI approach. See, net income approach, traditional approach. And third one is your Modigliani and Miller approach or hypothesis. This is also important when we will be discussing 1963. For this hypothesis or Modigliani Miller approach 1960, one is with tax, another will be without tax. This is there. Here that capital structure relevance theory under the net income NI approach, traditional approach, Modigliani and Miller approach 1963 with tax. and this cases capital structure relevance theory, here it will be in two part. In two part this will be there. That is, one is your net operating income, net operating income, NOI approach, and another one is same way Modigliani and Miller approach 1958 without tax. See, two different years it has been done. Initially it was without tax. 1963 it is with tax. So you see that these are the theories, your capital structure theories, on what basis we can select an ideal capital structure, so that your both these factors, your risk factors, your maximization of the firm's value, all those things will be taken into consideration, and definitely you have to make an ideal compositions of your capital structure based upon this theory. Capital structure relevance theory में net income traditional approach, approach 1963 without tax, you have to keep in mind. Another thing, your capital structure relevance theory, net operational income NOI and hypothesis without tax. So today we have discussed whatever the relevant theory portions under your capital structure compositions till your this capital structure decisions and capital structure functions, all those things we have discussed along with this theory. So today आज के लिए इतना तक हमने रख रहा हूँ. My next video onwards I will be giving all this one approach wise with problem solution sessions will be coming. So please do subscribe to my channel so that it will be in wide circulations. आज के लिए इतना तक. Have a good day.